Welcome back to the Rural Roundup, brought to you in association with the Scottish Government. On today's programme, we'll be joined later on by Andrew Coalter, who'll talk us through some of the key changes announced in the recent budget. But first, Mary-Jane, how are things in the Lothians?
Yeah, good, thanks, George. We're probably, like most of our consultancy offices, very busy with carbon audits at the moment for the PSF deadline. So that's keeping me busy, but it's a nice way to get out on farm and chat to some of my clients. And just at home, the usual feeding and bedding of the cattle. Kids are all very excited for Christmas. So I've got 3 boys that are getting pretty excited, and all the usual nativity plays, choir concerts, and all those sorts of things. And you, I'm sure you're the same in your house, George.
Yeah, there's something next week to go to, and obviously trees are up and such like, and yes, advent calendars every day. It's just part of family life at Christmas time.
Yeah.
Weather-wise, I'm pretty certain you're the same down with you as what we are up here. The dust of the summer's giving way to dubs. Everything is just very, very wet. And we've gone from one extreme to another.
Yeah, well, as we're recording, it's storm something or other. I'm not even sure what it is today. Very wet is the main feature of today's storm. So, I think long overdue some rain, though, so we shouldn't complain too much as long as it remembers to stop.
Yes, aye. Now, it may be Christmas time, but there's no need to be afraid. Myself and Mary-Jane are here to update you on what you need to know, and more importantly, what to do about it. The end of the year, or 31st of December, brings a few key deadlines, Mary-Jane.
Yep, as well as making our New Year's resolutions, which I don't believe in, but you may be making resolutions for the coming year. It's a good time to make yourself aware of all the various deadlines that we've got. So, beef calf scheme, deadline for claiming is into the new year, but it's worth getting it done before Hogmanay, just to make sure that you've got everything on there. So the advice from the department, George, is to claim everything that you believe is eligible. Isn't that correct?
Yes. So there's still the same rules there in terms of age, as we've had in previous years, and in terms of the 410-day eligibility for payment, that will be calculated. So basically, all the calves that would have been put forward before, whether or not they tick the box in terms of 400 days, the department will calculate that.
Yeah, and you can check that yourself on Scott EID. There's a handy section called My Herd Stats, which if you click in there, there's some useful information about calving intervals, among other things. But as you're saying, George, if you're not quite sure, maybe it's slightly over that or slightly under that, best just to stick all your calves on and they'll sort it out for you. That way you're not missing out on any payments.
Speaking of My Herd Stats, it's something I looked at a while ago, but I think it's probably been developed since. You're using it more and more now in your day-to-day role.
Yeah, I believe it's been around for a while, a year at least, but it's not something that I was actively using. But I've discovered a really useful report in there for getting monthly totals of livestock, and it breaks it down handily for us for doing a lot of carbon audits at the moment. It breaks it down into the age categories that you might need for something like preparing an agricultural carbon audit, maybe some of your QMS inspections or, department livestock inspections. There's some really useful information on there. You obviously need your own records at home in some format, whether that's paper records, an Excel spreadsheet, or some sort of livestock program. But it's useful to go in there and just sense check it, sense check your own records against what's on Scott EID. So there's some really useful reports on there. So it's found on the main Scott EID webpage. Once you've logged in, it's down the left-hand side. There's a tab that says My Herd Stats. Click on there and you can't do anything wrong. Just click away, have a go at the different reports and see if any of them are of use to your business. I've certainly found it very useful, as I say, for carbon audits, and I'm sure there'll be other uses for farmers that are listening.
Yeah, so handy tool there, and it's free. So
absolutely,
all good. The one other key 31st of December deadline, PSF. It's been around for a few years, but it's the same rules as in previous years. You can claim back anything that is conducted or done in the calendar year. So that applies to carbon audits, soils, and animal health and welfare interventions. We realise that when this goes out, there's probably not a lot of time left. So basically, get your skates on would be the message there.
Yeah, absolutely. And anyone that's maybe waiting for an invoice from someone that's done work for them, just chase that up if you've not had it yet. So things like if you've had soils done, carbon audits done, you need the invoice in order to claim by the end of February. So if you've not had one and you've been expecting it, maybe just check that as well, because you need the invoice paid in order to claim in February. So just give yourself plenty of time to make sure you've got that invoice, got it paid, and then crucially get a bank statement as well. So anyone that's not got digital banking, that can be take a bit more time. So just follow those things up.
I'm sure you've seen instances as well that people have maybe waited till the end of January to pay things, thinking that they're going to get their January. A bill's going to show in their January statement. However, for whatever reason, it's not gone through into February, and the bank statement's not going to come through until the following month. And it just means you're trying to get stuff from banks and things like that.
Yeah, which is more difficult when there isn't as many local banks and if you don't have digital banking. So just bear that in mind if you don't.
Yeah.
The final thing to remember as we come into the new year is that from the 1st of January, we're starting the new greening ecological focus areas regulations. So if you're doing greening for the first time or changing some of the areas that you used in previous years, just make sure you're familiar with the guidance on start dates for the various options. And you can find all them on the Rural Payments website.
And I should also say there are several videos to help guide farmers basically with the enhanced greening changes.
Yeah, absolutely. Farm Advisory Service, you'll find them on our YouTube and some of our socials as well.
Yeah. We're joined today by Andrew Coalter, who is a senior agricultural consultant and area manager at SAC Consulting, Perth. In a previous life, Andrew, you were an accountant. Could you tell us a wee bit more about your background and how you've got where you are, basically?
Hi, George. Thanks for having me on. Yes, absolutely. So before I worked at SAC Consulting, I spent a number of years working in practice as an accountant. So I've taken a slightly different route into agricultural consultancy than most people have. I actually studied accountancy and finance at university. That was my first degree that I completed. And I went on from there to get a job with one of the large accountancy firms in Edinburgh, and completed my accountancy training there while being a financial auditor of all things. So that was quite an interesting time where I actually worked with huge range of clients. So there was everything from FTSE 100 companies to household pension funds that you'll have heard of before, right down to forestry clients. There was a couple of national forestry clients in there, even some tech startups as well. So there was a really broad spectrum of what I was working on there. But I'm from a farming background. You can't take the farm out of me, unfortunately. So after I qualified as an accountant and then took the step to working in rural accounts in agriculture. So that was dealing with agricultural businesses, primarily in the Central Belt and in Fife as well. So I spent a number of years doing that. However, I didn't, obviously had too much free time. So I also then completed some further studies with SRUC, and then made the sidestep into agricultural consultancy. So it's quite interesting. It means that in SAC, I come at problems with a slightly different perspective to most consultants. Generally, anything with a pound sign gets thrown my direction. Whether that's good or bad, I don't know. But that's how I've made it to where I am today.
So, Andrew, that makes you ideally placed then to not only discuss how the recent budget affects people in general, but also taking it into a more rural slant, how it's affecting farm businesses and other associated agricultural trades. So what was your first thoughts when you saw what was announced in the budget?
Yes, so I actually thought that this was quite an interesting event. A few things have happened over the last couple of years. The government have now confirmed that they are going to focus on one major fiscal event a year in just the autumn budget. In the previous government, we had a spring event and an autumn event. I think that's a good thing. It brings a bit more stability to the markets, and stability is key in the financial world. As you say, I'm obviously looking at this from a slightly a slightly more agricultural view, which hopefully provides a bit of helpful insight here today. The budget that we saw at the end of November was quite interesting. It was the second budget of this Labour government that we have at the moment. This was very much a tax and save budget, not a tax and spend budget. Interestingly, the Office for Budgetary Responsibilities report got leaked a couple of hours beforehand, so we actually knew a lot of the detail that was going to be announced before Rachel Reeves even stood up. What we found through that report in particular is that some of the growth that we were told would take place, some of the extra revenue that would be raised, things like that, haven't really materialised. So that left the Chancellor with it left her on the back foot from the start. It meant that she had less money to play with and that she was going to need to raise more funds to meet their own fiscal rules that are applied to ensure that we're not borrowing too much against the economy. So the budget this year effectively just focuses on raising additional revenues to restore that sort of financial stability that they need to see within the overall government budget. What they're trying to do is balance the books there by raising taxation rather than implementing, major spending cuts that we might have seen under previous governments.
And from a farmer's point of view, Andrew, I think we'll all have read the press about what the biggest tax implications are. We're talking about inheritance tax, or I'm talking about inheritance tax here. Can you sort of give us a summary of what the budget has confirmed for us? Because we've been talking about this for a wee while now, but this autumn budget hasn't really meant any significant changes to that, has it?
No, it hasn't. It's effectively confirmed what we already knew to be the case. It's quite interesting. When the changes were announced last year, they were met with a lot of backlash from the agricultural industry, which was to be expected. There was also a lot of lobbying from the farming unions and also some support from, supermarkets, retailers, other people in the supply chain, which was really helpful. In an ordinary political environment, I think it would have been fair to say that would fall on deaf ears, but we're very much not in an ordinary political environment at the moment. Labour's ratings aren't particularly high. There's been a lot of pressure from opposition parties to say that actually these changes are the wrong things. So there's been a lot of rumours flying around over the last number of months that changes might be on the horizon. There was one report in particular that came out from a group called Tax, which suggested an alternative approach to what the government had suggested, but in reality that didn't come to pass. What we did see in the autumn budget was a confirmation of the changes that were announced last year. So what that means is that on an individual level, you're eligible for up to £1 million worth of combined agricultural property and business property relief, and anything over that amount will be taxed at 50% of the full rate. So any value you have in your personal estate would be taxed at 20%. So that's all been confirmed. The only change that was announced in the autumn budget this time round is that £1 million is transferable between spouses, and that is beneficial. That allowance can be transferred.
And that's only married couples. It's not, long-term partners or anything like that. You need to be...
No, it only covers spouses and civil partners. It doesn't cover people that are just living together. No.
I know there was, when this inheritance tax was first announced, there was this feeling that perhaps it might change. They might reverse their decision. But this really just reiterates that, I think. What's your advice now to farming businesses that have maybe just held back, haven't rushed into anything? What should they be thinking of doing now?
That's a really fair question. I think one of the problems that we see in the agricultural industry is the return on investment, or the return on equity for the fundamental value that sits in our land. The financial return that we get on it each year is actually quite low. I think that's where agriculture faces bigger issues than perhaps other industries. It's important to remember that these changes to inheritance tax apply to all businesses. So it's agricultural property relief that's affected, but also business property relief. So this affects everyone in, the construction industry, in the retail industries, whatever it is. But I think part of our issue in agriculture is that return on investment, that profitability figure. If we were to take some statistics from the Farm Business Survey data, if you're making a 1% return on equity, you are above average in the UK. So that means if you're sitting on a farm which has a capital value of £5 million and you're making a profit of £50,000 a year, you're above average. That's the issue that really lies into the affordability of it for the agricultural industry. Whereas if you were in something like the construction sector, that return on investment is probably closer to about 4 or 5%. So let's say a £5 million business would be generating profits of about £200,000 to £250,000 a year. If that was the case, the affordability of this tax, it might be slightly easier to swallow. So that's one of the first challenges that we have, which is specific to the agricultural industry. But there are lots of things that we can do about it. What's come out of this autumn budget is that the changes are going ahead. We can't avoid that now. It is going to be written into law. The agricultural property relief and business property relief reforms are going to fundamentally change the inheritance position for farming families. So now is really the right time to review your position. The new transferability rule that we have for that unused allowance gave spouses a bit more flexibility, but it doesn't remove the need to restructure your ownership intelligently, if that's the right thing to do. In terms of practical advice, in terms of what people should do, make sure you review your wills, make sure you have a will, make sure you have a power of attorney as well is really important. If you are in a farming partnership, have a look at your partnership agreement. Do you know what it says? There's no standard partnership agreement in Scots law, and actually there's 2 or 3 different ways. There's 2 or 3 sort of standard variations on what happens when a partner dies. So it's helpful to know what that is. But make sure you're reviewing wills, partnership agreements, and understanding your asset valuations now, not after the reforms take effect.
I think that's important advice about wills and powers of attorney and partnership agreements. And I think people maybe have historically put them off because it can cost thousands of pounds to do that with professional advice. But from what you're saying, Andrew, that's thousands of pounds very well spent, because it'll save you a fortune in the long run if something's not right and you discover too late once somebody's passed away, and then you're in a bit of a muddle.
Oh yes, absolutely. There's no doubt about that. Since agricultural property relief came out in its current format in effectively the late 1980s, agriculture has been in the very fortunate, Scottish agriculture and UK agriculture, we've been in the very fortunate position of not having to worry too much about inheritance for the future. We've also been in a really strange tax system, which has actually incentivized farmers to hold on to land until they die, and that's for a couple of reasons. The first is that you would get 100% inheritance tax relief, providing that your farming business qualifies for the reliefs that are available. But secondly, there's a big advantage to holding on to land until you die for capital gains tax purposes. If you pass on land when you die, the person receives that farm, but they also receive it at today's market value for capital gains tax purpose. They get a tax-free uplift in that base cost, is what it's known as. Whereas if you pass on a farm while you're alive, obviously the person who gets it still gets that asset, but they would also obtain your base cost from when you took over the farm or bought the farm, or when the farms were all rebased for capital gains tax purposes. If somebody's going to continue farming that for the rest of their days, is not an issue, but let's say that farm was to be sold 1, 2, 5, 10 years down the line, whatever it is, that can make a really significant difference if they've had that uplift in capital gains tax base cost. So it means that farmers in the UK have actually been incentivized to hold on to land until they die. This has flipped it on its head. I can understand why there was lots of calls in the industry to perhaps put in an exemption for people over a certain age who have set up their tax affairs for this very purpose and now need to do the opposite. But what it means is that as an industry, we really need to be tackling succession head on. Succession planning is absolutely essential in the agricultural industry to ensure the continuity of your business, to ensure that the tax bills that are coming when you inevitably pass away are either not unexpected or not crippling to the continuation of that business.
I have heard some people considering that they've maybe held on to the farm business until they're, it's not uncommon to hear of farmers in their late 80s still being the main owner, almost skipping a generation now. Son or daughter might be in their 60s, and now considering it passing down to the grandchild who's maybe in their 30s. That's that is the reality of where we're at, because, as you say, they were incentivized to hold on to it before, whereas now passing it down to someone in their 60s maybe isn't even the smartest move, depending on the financial setup of the business and who's all working in it. So I think there's a lot of a lot of different scenarios that people will need to take advice on, because no two businesses will be the same.
No, you're absolutely right in that. No two businesses are the same, and there's so many nuances to consider. Family dynamics are a big one as well. How many people are involved in the business makes a really big difference. But you're right, if we were just to take some of these businesses in the cold light of day, from a practical perspective, maybe it is the right thing that it skips a generation and goes from that old grandfather who still holds the checkbook and everything else, and it goes down a generation. There's all sorts of practicalities to consider with that as well. Everyone still has that £1 million of agricultural property relief available to them. So let's say the next generation, if there's a husband and wife there, for example, would have £2 million worth of relief available. It's also hard to beat owning the house that you live in as well. I would just say that as perhaps somebody who takes a more cautious approach to these things. The other factor is that we can plan for the expected death, let's say the person who is, in the later years of their life, but there can always be scenarios where perhaps the younger person passes away first. And if all that land has been passed down to them, maybe that brings its own issues as well. So there's no one-size-fits-all approach here. It's a case of sitting down as a family and figuring out, do you know what people want to do? Do you understand everyone's perspectives? And then making sure that everyone's on the same page with this. Leaving people in the dark and just waiting, for it to come out in your will isn't necessarily the most helpful thing to do from a future family dynamics scenario. But you're absolutely right. It's something that needs to be considered, and each situation needs to be based on its own merit and its own circumstances.
In terms of personal taxes and wealth, there was a lot of rumours in the press that income tax was going to go up. It didn't, which was good news. However, there's been a lot of talk about things such as thresholds, fiscal drag, and even changes to investment limits and such like. So just what's the main points from there?
Yes, you're absolutely right, George. There's a few key points that need to be picked out here. In terms of all of the taxes that were raised, so there's about £26 billion of tax rises that were announced over the course of this government that will come into force. The majority of that actually comes from personal taxes. So as you've said, there wasn't actually an increase in the rate of income tax or national insurance, etc. But what we do have is a freeze on some of the thresholds, which in effect is a stealth tax, because as wages increase over time with inflation, people end up paying more tax for doing the same job. What was announced is that the income tax and national insurance thresholds, which were already to be frozen until 2028, I believe, will be frozen for another few years until 2031. It's quite important to be aware that income tax itself is a devolved matter in Scotland, but the freeze to the personal allowance, that £12,570 per year, and for the national insurance thresholds, that does apply in Scotland. So off that 20-something billion pounds of tax raises that were announced, there was over 8 billion of that came from the freeze to income tax and national insurance thresholds on their own. In terms of other tax rises or changes to thresholds, income from dividends and savings, the tax rate will increase by 2%. And there was actually quite a big announcement around ISAs as well. So at the moment, if you want to invest either in a cash ISA or a stocks and shares ISA, you can invest up to £20,000 per year. From April 2027, it's being changed that you can only invest £12,000 a year in a cash ISA, but you still retain your £20,000 total allowance. So the difference could be put into stocks and shares, or you could just put 20,000 into stocks and shares. What they're trying to do there is encourage investment in the UK stock market rather than people just putting money into cash ISAs, which historically have yielded lower returns and don't really do anything to kickstart or boost the economy as a whole.
The income tax thresholds that you were just talking about there, Andrew, it sounds like that's going to raise a big proportion of the money that they're looking to raise here, but that's going to affect everyone, not just farmers, obviously. And when we're talking about the inheritance tax, that affects a lot of farming businesses, but the impact of the income tax thresholds is going to be felt by everybody, isn't it? Something that we all need to plan for.
Yes, absolutely. The practical effect is that over the course of this government, most individuals and businesses will end up paying more in tax over time. The overall tax burden has been well talked about in the news. We're now at the highest level since World War II, effectively. But it is something just to be aware of, particularly if you employ staff in your business. This is something where you need to be aware of the additional costs that are coming on. So there's going to be more tax that needs to be paid, just as thresholds are frozen. But there's also been a change to the national minimum wage and the national living wage as well. This is something that has increased this year, but also increased quite significantly last year. So if we take somebody who is over 21, from April 2025, the national living wage goes up to £12.71 an hour from the current rate of £12.21. However, if we compared that back to 2024 rates, which were £11.44, it means that there's an 11% increase for people in that category over the last 2 years alone. So actually, for industries that have really high levels of employees that are paid in or around that national living wage, national minimum wage, that can make a really significant impact on cash flows and profitability. So something that needs to be prepared for.
Yeah, and that's good news for employees, obviously, especially folk that are maybe struggling financially, but yeah, as you say, impact the businesses. In terms of agricultural wages, we do have an agricultural wage advice thing, don't we? I haven't actually looked at that to see what the Agriculture Wages Board have set their living wage at. Do you know if that's different from this national living wage?
That's a good question. I would need to check that, but I believe at the moment it's just effectively in line with the national living wage.
Okay.
There might be some caveats to that depending on the level of qualifications a person has, but I believe it's around that same amount.
Yeah, so worth anyone that's listening who has employees just checking that the agricultural wages, that you're not falling foul of any minimum levels for that as well when you're considering your employees and what you pay them.
And taking a broader outlook for farming businesses, there's also been a number of changes to capital allowances and investment.
Yes, there has. There's been a number of changes announced in the autumn budget. First of all, it's quite helpful to note that the majority of investments in plant and machinery is likely to be covered by the existing allowances. So if you're a limited company, full expensing is available. What that means is that any main rate plant and machinery purchases that are brand new can be fully expensed against your taxable profit within the year of purchase. There's no limit to the amount of plant and machinery that you can buy under that full expensing rule. If you are a sole trade or partnership, you're relying on what's known as the annual investment allowance. So the level of the annual investment allowance has changed in value quite a bit over the last 10 years, but actually you can get up to 100% relief on up to £1 million worth of qualifying plant machinery. That covers new machinery. It also covers second-hand machinery as well. So in reality, for most farming businesses, that's going to cover your normal annual expenditure. But if you're undertaking perhaps really significant project, which puts you across that £1 million threshold, or for other reasons, there are a couple of changes to be aware of outside of full expensing and the annual investment allowance. The first is a change to the writing down allowances that are available. So the main rate writing down allowance is going to be reduced from 18% to 14% from April next year, which means that the rate that tax relief is given will slow down for assets that are obtaining tax relief in that way. It means you get a smaller annual deduction on the tax value of that qualifying plant and machinery. The other relief to be aware of is a new 40% first year allowance. So this is for investment in brand new main rate assets that either don't qualify for full expensing or aren't already covered by the annual investment allowance. So if you have a significant amount of investment in a year, that might actually be beneficial for you. But over and above that, any items in that sort of writing down allowance pool will get 14% rather than 18%.
What sort of items are you talking about there, Andrew, for the sort of larger investment? What sort of things would be eligible for that extra allowance?
So there's been a number of interesting cases in recent years regarding capital allowances and what is eligible and what's not. But in terms of significant investments, we might be looking at people that are perhaps, putting up new grain stores or tatty stores, things like that, for people that are installing, large scale dairy installations, or perhaps people going down the route of anaerobic digestion, that sort of route as well, where there's been significant investment in a year that perhaps takes you across that £1 million threshold. That's going to cover most investment for sole trades and partnerships. That might be where you're looking to consider that as well. We also find some scenarios where partnerships don't qualify for the annual investment allowance, which might be because they have an old corporate partner. One of the partners in the partnership is actually a limited company, which used to be used for tax planning purposes, but that benefit's sort of been eroded away over the years. But that might be another scenario where the annual investment allowance isn't available, and in that case, this new first year allowance might be really beneficial to businesses like that.
So worth checking with your accountant before you're considering, doing any big investments. Just checking what those impacts might be.
Absolutely, that's generally a good rule of thumb, isn't it? If you're taking any sort of significant investment, one is making sure you have the finances in place to be able to fund it. But secondly, speaking to your tax advisor as well, speaking to your accountant to ensure that all the correct reliefs are being obtained, whether that's for VAT or for capital allowances, and making sure we can recognise as much of that as we possibly can.
Yeah.
Now, in the budget as well, there were a few changes to some of the things that affect our day-to-day lives and also farming businesses.
Yes, that's right. There's a couple of things there of note. The first one will be fuel duty. That affects most people who will be listening to this. Fuel duty has been frozen in the UK for quite some time, but the government have now announced that from April 2027, it intends to raise fuel duty in line with inflation. There has also been a temporary 5p cut in fuel duty, which is going to be reversed by March 2027. To be honest, that means that the prices of the pumps are likely to increase. At the moment, about a third of the price of a litre of diesel is fuel duty, so it's quite a significant proportion of what you spend already, but that is something that's going to increase over time. They also announced a new electric vehicle excise duty. That might apply to a few less of the farmers on here, but there will be some people. But from 2028, it means that there's going to be a pay per mile taxation for electric or plug-in hybrid vehicles. Now, the mechanics of this are still quite unclear. I've seen a few pieces and a few interviews post the budget where actually the government don't seem really sure how they're going to implement this yet, but that'll be figured out in due course. The idea of it is that drivers of diesel and petrol cars are paying an annual road tax charge, but they are also effectively paying per mile for using their car through the fact that they are paying for fuel duty at the pump. So the pay per mile electric vehicle excise duty is designed to replicate that. So rather than paying tax on your fuel as you fill up, you will pay an annual charge as well that covers road tax and a nod towards fuel duty as a contribution towards the roads budget, etc.
And over the past number of years, we've seen a move by HMRC to making businesses digital, making tax digital.
Yes.
There's a continuation of that trend.
Yes, you're absolutely right. So making tax digital for VAT was the first stage of this. That rolled out a few years ago now. And what we find is that any business that's VAT registered needs to file digital submissions with HMRC. So for most people, that means you're using an accounting software, whether that's Xero, Sage, QuickBooks, FarmPlan, plenty other options are available out there. But for some clients, manage to sidestep around that by using what's calling bridging software. So I know a number of clients who continue to maintain their paper records. They provide that to their accountant in a sort of Excel format, and the accountant uses a bridging software to digitally provide that to HMRC. So that is something that's going to change from April 2029. All VAT invoices will have to be issued in a specified electronic format. So effectively, it means there's going to be mandatory electronic invoicing for VAT registered businesses. There will be a roadmap for how that's going to be developed and implemented over the next year or two. So that's something to watch out for. In terms of making tax digital, there's also been the announcement of making tax digital for income tax as well. Something that has been scrapped already is making tax digital for corporation tax, but they have said they're committed to ensuring a more digitized tax system. But from April 2027, another announcement was digital prompts in VAT filing software. So it means that businesses will be prompted towards any abnormalities at the point at which they're filing their VAT returns. So what we can see here is HMRC is really taking the drive towards digital technology on board. That's for a few reasons. It's to streamline processes on their end, but it's also to help counteract fraud and reduce any risk of either fraud or unintentional errors in the VAT and the tax system.
Thanks, Andrew, for a thorough update on the budget and what it means for individuals and farming businesses. Now, Mary-Jane, there are a number of upcoming events after Christmas and New Year that listeners may be interested in attending.
Yeah, absolutely. I've got a personal interest in one of those as well, George. I oversee the Farm Advisor Service Women in Agriculture delivery. So we've got 2 conferences coming up. One is for the Women in Agriculture members. So it's on the 11th of February at Murrayfield Stadium in Edinburgh again, on the theme of land, legacy and leadership. The Women in Agriculture conference is followed the following week by the main FAS conference, which this time is going to be in Inverness on the 19th of February. And it's all about tech in agriculture. So if you want to check out either of those things, go to the FAS events page. And George, you've also got some agronomy roadshows coming up as well.
That's right. The Arable roadshows are at the first half of January. There are 3. There's one down in the Borders on the 8th of January, one in Perth on the 13th, and one up in Aberdeenshire on the 15th of January.
So lots of things to look forward to, whether you're an arable farmer, interested in tech or a women in ag. Anyone welcome to come along to any of those things. Free to attend. Anyone can sign up, and for full details, just check out the FAS website.
Yeah. Thank you for listening to this episode of the Rural Roundup. We'll see you back here on the 21st of January with our next episode. Now, on behalf of everyone here at Rural Roundup, we hope you have a great festive season, enjoying some downtime with friends and family, and have a prosperous and happy 2026. This episode was hosted by George Chalmers and Mary-Jane Lawrie, featured our guest Andrew Coalter, and was produced by George Gawley and edited by Cameron Waugh.
The Farm Advisory Service Podcast. Audio advice on livestock, crops and soils, environment, rural business, and more. Brought to you in association with the Scottish Government.